Today I want to talk about a couple of very interesting charts that I came across over the last couple of days that reveal a problem that I think most investors aren't aware of. So without further ado, let's get started. All right, I just want to sit down and talk very briefly about what is referred to as the diversification illusion of the S&P 500. And I think that's a problem, and I'm going to explain why it is a problem in a second, that most retail investors, maybe to some extent professional investors as well, aren't aware of. So let me show you the first chart that basically reveals what I'm going to talk about today. So here we see a chart from Apollo Global Management that looked at the combined weight of stocks with a weight of 3% or more over time. And let me just read to you what they were describing, concluding, and what they find concerning. So they write, the finance textbook says that investors should diversify their investments, but there's little diversification today when buying the S&P 500. The combined weight of stocks with a weight of 3% or more in the S&P 500 index is at an all-time high and continues to rise. See chart below. So let's just zoom in into the chart here real quick. So what you can see here is that as of late 2024, I think the chart was revealed in November this year, if I'm not mistaken. I might be wrong, but sometime in 2024, we see that the combined weight of stocks with a weight of 3% or more is exceeding the 30% mark. And historically, going all the way back to 1995, the weight has usually been below 10%, and for quite a long period around the 5% mark. But ever since 2016, we have seen a pretty steep increase of that combined weight, which, as I said, has now crossed the 30% threshold. They continue to describe the bottom line is that buying the S&P 500 gives the impression that you are buying 500 different stocks and diversifying your investments. But the reality is that the high and growing concentration in the S&P 500 continues to be a major problem. In short, investors should ensure that their portfolio is not all levered to Nvidia earnings. And they are right. Nvidia represents a meaningful part of the S&P 500 today. How much exactly we will look at in a second. However, what they don't reveal in this short paragraph is why it is a problem. Because what I will say is that someone who is actively trying to understand what I own, I don't find concentration itself problematic. It may be more problematic for the average investor that just wants to invest passively because, of course, with a higher level of concentration comes higher volatility, and volatility may lead to human beings making decisions that are maybe irrational because they can't deal with the price movements that come with an increased volatility. To me, that's not a problem because price movement itself doesn't represent risk. What I would consider risky is business fundamentals deteriorating or, and that's basically the point I want to make here, businesses trading at prices that will lead to disappointing returns going forward. So I will look at the valuation of the highest weighted stocks in the S&P 500 in just a second. But before we do that, let me just show you the highest weighted stocks in the S&P. So what you can see towards the bottom of this chart, and this is taken from the fact sheet of the VU S&P 500, so the Vanguard S&P 500 ETF. The top 10 positions in the S&P 500 as of today represent around 36% of the overall 500 companies. And the largest one, so take Apple, Microsoft, and Nvidia, for example, combined already represent around 20%. If we look at the 5 highest weighted stocks, we get to a percentage of, let me do the math real quick here, 8, 14, 20, 27%. So that's quite astonishing. 5 names account for 27% of the overall index. And I can guarantee you that your average investor that is passively investing into the S&P is in fact not aware of this level of concentration. So again, why is this problematic? I think it's not necessarily problematic because of the quality of the top 10 or the largest weighted. We may talk about the 20 or 30 largest companies in the S&P 500. It's not that the fundamentals of these businesses are deteriorating or facing fundamental headwinds. No, quite the opposite is the case. Many of the names you just saw are tech names that are benefiting from many tailwinds, secular tailwinds that we are seeing right now, like AI. What is problematic, however, is the valuation that these stocks some of these stocks trade at. So what this chart here actually shows is the price to earnings ratio of the 10 largest names in the S&P as of November 2024. And what I want to focus your attention on is the average price to earnings ratio of the top 10 names, which stands at almost 50 times earnings. The biggest contributors to the seemingly optically very high valuation metric are Tesla, which is trading or was trading back then at a price to earnings ratio above 100 times earnings, Broadcom with a price to earnings ratio of 66 times, Nvidia with a price to earnings ratio of around 63 times. And the other names are, of course, not necessarily optically cheap, but especially Meta and Alphabet, so Google and Berkshire Hathaway, seem to trade at more reasonable PE ratios. So again, let me stress one more time that concentration itself in high quality companies, I think is not a problem, especially not for active investors who know what they own. I think it might be a problem regardless of the underlying quality for passive investors because, as I already explained, concentration usually leads to higher volatility, which can lead to suboptimal outcomes because then behaviorally, many investors may make suboptimal decisions. The problem I see with the level of concentration in the S&P 500 right now, however, is more related to the valuation of these names. And just to back up the point that most investors, private investors, your average investor, doesn't seem to be aware of this issue, is reflected in this chart here. Here we can see the percentage of respondents that are expecting stock prices to be positive in the coming years. And again, we can see, looking back at more than 30 years of data, that we are sitting at an all-time high level. Once again, this is another data point that is backing up what I was describing in many of my other videos before, that the current investor sentiment is at an all-time high. It's almost like you can sense the euphoria in the market. So more than 50% of respondents are expecting stock prices to continue to rise in the coming years. And this is actually reminding me of another tweet of Theo Burkhardt that I was reading just today. I was just thinking of it now that I'm recording the video, so I'm going to make sure I'll include it in post-production. So he wrote, recency bias, which is one of the cognitive biases that is massively influencing investors' decisions, may represent a problem going forward. And this is what I think we are seeing in the chart that I was just talking about as well. So Theo was writing, academic research shows that investor expectations for future asset returns in the next several years are highly correlated with returns in the past year or two. So in the past 2 years, the S&P has seen two, I guess you can call it blockbuster years. This year, the S&P is up something like 27, 28%. And last year, it also generated returns above 20%, if I remember correctly. So, of course, if you think about it psychologically and if you understand human psychology, investors are expecting positive returns going forward. But as Theo then points out, you might, or in fact, you should probably expect the opposite. So he writes, stated differently, investors expect high returns after realizing high returns and expect low returns after realizing low returns. This is quite strange to me, and it is quite strange to me too. When one studies financial history, it clearly entails the opposite story. Assuming you are targeting assets of high quality, one should expect high returns after realizing low returns, and perhaps, but not always, vice versa. So let me know what you think of the S&P as an investment right now. Usually, someone who is investing passively should just set it and forget it, set up a savings plan, not think about it all too much, just contribute money on a regular basis, on a monthly basis or quarterly basis. However, right now, I wouldn't have a good feeling recommending dollar cost averaging in the S&P 500, for example, just because the largest weighted names, which now represent a majority of the index, are trading at quite high prices, possibly leading to lower expected returns over the next 5 to 10 years. Let me know whether you agree with me or not, and I'll see you in one of my next videos. Take care.